Trying to analyze a stock can feel like you're drinking from a fire hose, right? There's just so much information. So, how do you cut through all that noise? Well, today, we're going to borrow the playbook from one of the greatest investors of all time, Warren Buffett. We're going to apply a simplified version of his checklist to a major company, PNC Financial Services. Okay, let's dive right in.
This quote right here, this is the foundation for everything we're about to do. It's the absolute heart of value investing. See, in Buffett's world, the goal isn't just to buy cheap stocks. It's to buy a truly great business at a fair price. So we're not just going to be looking at a stock's ticker price. We're going to try to understand the real underlying value of the business itself.
And here's our game plan. First, we'll lay out the framework, what we're calling the Buffett yardstick. Then, we'll put PNC's profitability to the test, check its financial health, analyze the price, and finally, we'll bring it all together for a final scorecard.
So, let's get into it. To help cut through that fire hose of data we were talking about, we've basically distilled Buffett's decades of wisdom into a simple framework we're calling the Buffett yardstick. It really just boils down to these three simple but super powerful questions. First, does the company consistently make money? Second, is it financially solid, or is it kind of drowning in debt? And third, and this is the big one, even if it's a great company, is the stock being sold for a reasonable price? Let's go ahead and apply this to PNC.
All right, first up, profitability. A great company, in Buffett's eyes, isn't some one-hit wonder. Nope, it's a machine that just reliably churns out profits year after year. So the question is, does PNC fit that description?
Our first stop is a metric called return on equity, or ROE for short. You can think of it like a report card for how well the company's management is using your money, the money invested in the business, to actually generate profits. What we want to see is a nice, high, stable number.
Now, what's really interesting here is the consistency. PNC's current return on equity is 10.77, which is almost exactly in line with its 3-year average. What does that tell us? It tells us that management is performing with predictable stability. It's a great first checkmark for the business. But, consistency isn't quite enough. We also need to see growth. Is the business actually getting bigger over the long haul? To figure that out, we need to look at the growth rates for its revenue, its net income, and of course, that all-important free cash flow. That's the actual cash the business has left over after paying all its bills. It's the money it can use to grow, to pay dividends, or to buy back its own stock. And this table, well, it shows a really mixed picture. So what's going on here? On one hand, revenue growth is fantastic. I mean, look at that, over 14% over 5 years. But then you look at the other side. Both net income and free cash flow have actually shrunk over that same 5-year period. This could mean expenses are rising faster than sales, or maybe the company is making some big investments. Whatever the reason, it tells us that while more money is coming in the front door, less of it is actually turning into pure profit and cash. And for a Buffett-style investor, that's definitely a yellow flag. But before we move on, there's one major positive in this section that really stands out. As you can see, PNC has raised its dividend for 15 years in a row. Now, for an investor like Buffett, this is way more than just a number. It's a powerful signal that management has long-term confidence in the business, and it shows a real history of rewarding shareholders, even when profits might take a dip. It shows discipline and a shareholder-friendly mindset. All right, so we've seen that the company is profitable, but can it weather a storm? That brings us to our next section, checking the company's financial health. A great business has to be able to survive the tough times, and that really means not being overloaded with debt.
The key metric we look at here is the debt-to-equity ratio. It's a really simple comparison of what the company owes versus what it owns. Basically, a lower number means the company is less reliant on borrowing money to run its business, which generally means less risk for investors. Simple as that. And PNC's number? It's 0.71. For most industries, any ratio under 1.0 is considered pretty healthy and conservative. This suggests PNC has a strong balance sheet and isn't overdoing it on the debt. So it passes our second test with flying colors. That's a big green checkmark. All right, this brings us to the final and maybe the most important question in the Buffett checklist. We've established that PNC is a profitable, financially healthy company. But are we being asked to pay too much for it? Is it a good company at a good price? So we can start with a couple of quick clues. The price to earnings, or PE ratio, is 13.23, pretty standard for a big bank. But what really catches my eye is the PEG ratio. This little metric compares the PE ratio to the company's earnings growth rate. At 0.61, any number below 1.0 is often a hint that the stock might be undervalued relative to its growth. But remember, this is just a clue. To get the real answer, we need to use Buffett's ultimate test. And this, my friends, is that ultimate test, the margin of safety. It's all about figuring out what you think the business is truly worth, its intrinsic value, and then comparing that to its current stock price. Buffett famously wants to buy $1 of value for 50 cents. He demands a big discount, a buffer, just in case his calculations are a little bit off. So, this is the moment of truth. After all our analysis, does PNC stock actually offer investors that critical margin of safety at its current price? And the answer, according to this analysis, is no. In fact, it's showing a negative margin of safety of over 5%. Now, calculating a company's true fair value is pretty complex, but based on one of those models, PNC's fair value is estimated to be around $216. Since the stock is trading for more than that, it means there's no discount, no buffer. For a strict value investor following the Buffett playbook, paying more than a business is worth is a major red flag, period. Okay, so we've run PNC through our 3-part checklist. Now it's time to put everything we found on the table and look at the final scorecard. So here's the final weigh-in. On one side of the scale, we've got some clear strengths. A consistently profitable business with that stable ROE, that fantastic 15-year dividend track record, and a very healthy low-debt balance sheet. But weighing against all that on the other side are some real concerns. Those troubling long-term declines in income and free cash flow, and most critically, a stock price that appears to offer absolutely no margin of safety. So what you should really take away from all this is a picture of a good, solid company that, according to this value-based analysis, might just be trading at a not-so-good price right now. It's a classic case of separating the business from the stock.
And that really brings us to the end. This simple 3-step framework. Is it profitable? Is it financially sound? And is it fairly priced? It's not just for PNC. It's a powerful lens you can use to look at any company that catches your eye. So the real question is, where are you going to point it next?